From the Americas to Europe, in the Middle East, Africa, and Asia, policymakers are still trying to make sense of a global economic crisis that emerged in 2007. In the meantime, taxpayers across the world are shoring up financial systems. As finance moves back into profitability, the public wants assurances that there will not be a return to business as usual. And politicians are asking if we can redesign market capitalism. But could the determination to avoid repeating past mistakes mean that we miss warning signs for new dangers ahead? CNBC brings together regulators, politicians, and industry leaders to bring the focus back to the future, to identify the next major threat on the road to recovery. Ladies and gentlemen, please welcome your host, Maria Bartiromo.
Good morning, everyone. Good to see you all. Thank you for joining us here at the World Economic Forum in Davos, Switzerland. And to those watching at home, welcome. Is there a danger that the world economy could take a hit from the unexpected, just as it begins to recover? Could the strategies implemented to pull us out of the last crisis, in fact, lead us into the next? That's what we've brought you all here to talk about today. The possible challenges that could trip us up on the road to recovery.
Each of our three proponents will set out a case for an imminent threat to global stability. They will have 90 seconds to set out their initial argument. CNBC's Maria Bartiromo will then ask for responses from our three challengers and a distinguished front row. Once the debate is wrapped up, Maria will invite the proponent to address some of the comments and sum up his case in 30 seconds. Once all three propositions have been made, the audience will then vote on which argument has most convinced them.
Government money may have brought us back from the precipice, but are we now headed toward a new danger? I invite Professor Kenneth Rogoff to make the case that the banking crisis has morphed into a long-term government debt crisis.
Certainly things are much better than a year ago. The crisis is over. The panic is over. But there's an illusion of normalcy. The crisis is over because governments guaranteed everything and spent like drunken sailors. Understand, it's good that we didn't have a second Great Depression. The problem is that if one looks at the long history of financial crises, banking crises, all too often followed by a wave of sovereign debt crises a few years later. No surprise, debt is exploding. In the crisis center countries, it's gone up by more than 75% already. What do we worry about down the road? Well, in countries like the United States and Britain, I'm not talking about default, but we certainly may have to see very painful political crisis, belt tightening, higher taxes, slower growth. In emerging Europe, where external debts are huge and there were problems before the financial crisis, we could see worse. IMF programs, outright defaults. If you look at the history of financial crises, again and again this happens. We may tell ourselves, we're better, we figured things out. We won't have the political problems that other countries have faced in other times and other places. We're different. I submit to you, we're not. Thank you.
Thank you, Ken. A sovereign debt crisis. What are the ramifications, and is this truly the next risk we face? Let's hear from the challengers.
Congressman Barney Frenkel. We had a terrible economic meltdown caused primarily by irresponsibility in the financial system. The most important thing for us to do is to coordinate regulations so none of those trying to escape regulation will be able to play us off against each other with a kind of regulatory arbitrage.
Ming Zhu, Deputy Governor of the People's Bank of China. After hitting by this financial crisis, the world is very much on the road of recovery. People are a little bit optimistic now. I'm concerned about that. The road of recovery is a bumping road, a lot of potential risk in front of us. I think it's absolutely important for people to hear, to discuss this potential risk, so we'll be able to see the issues and prepare on the way of recovery.
Anand Mahindra, Vice Chairman, Mahindra & Mahindra Limited. My concern is, 1 year down the road, we're still running scared. Nobody has a clear idea of the road ahead. The risk is of not having the right leadership, enough of it in the right place at the right time. It's about time we got back confidence in the capitalist system and got back to work rather than wondering about what's right and wrong.
I completely agree, and I am frustrated that the major remedy for that is being left out. A substantial, sustained reduction in American military expenditures. Remember that our debt crisis began when someone decided to get the joint prize, Nobel Prize for economics and fiction, by putting forward the theory that you could finance 2 wars with 5 tax cuts. That's what put us in the hole. The wars are unnecessary. We are substantially overburdened, and I know there's been this concern that the dollar shouldn't be the standard currency in the world. Well, the Pentagon shouldn't be the fallback military for the world. We have substantially overspent, and I am very disappointed in the respectables in America who talk about cutting Medicare and cutting Medicaid and cutting programs like this.
So you agree the next risk to the global economy is a sovereign debt crisis?
No, I think what we face is a crisis, a debt crisis that won't be a sovereign debt crisis in the U.S. It may be elsewhere, but in the U.S. it will be a devastation of our ability to improve the quality of our life through federal programs.
See, I think we're overlooking 2 things here. One is the inevitability of a run-up in debt in a recession like this, and the second one is the circularity of a debt and growth cycle. The fact is that without government bailouts, without fiscal stimuli, growth and unemployment would have fallen even more sharply, resulting in even higher fiscal deficits. There would have been higher unemployment payments. There would have been a sharp fall in tax revenue. And I think, Barney, even in the US, if you remember, in 1950, when the federal debt in the hands of the public was up to 80% of GDP, by 1960 it was down to 46%. What happened? You grew your way out of that sovereign debt crisis. And to me, if Keynes is right, and I think he's been proven right more than once, this is like a Formula One race. You've got to take a pit stop, you've got to fuel up, and then get back in the race. If you don't fuel up, you're not going to get back in the race. Now, you can do that with some caution. You need some liquidity ratios. And I think we are doing that in Basel III, some have been suggested. The Indian banking system is actually secure because we follow the statutory liquidity ratio, which we learned from the British of 19th century banking. Now, we Indians love to malign the British and what we've learned from them. This is one thing I think we owe them for.
Jimin.
It seems to me for this coming year, the real risk for the global economy is a very weak and volatile economic growth. I mean, currently, people tend to be optimistic because they hear good news. For example, people even forecast years will have a forecast GDP growth rate about 5%. But you have to remember, that 5% is based on very, very low base we had last year and a few quarters before. I think it is absolutely important. The world is facing 2 absolutely important soft landings. One soft landing is from current, I will call the government stimuli supported the rebound growth and landed to the self-sustained growth, which is corporate investments and private consumption-driven growth. But further, even we land the self-sustained growth, we need to further land to the real balance, the structural economic growth. Everyone have to do structural reforms. There's no guarantee everyone and all the economy in the world will be able to do smooth 2 soft landing. I think it is absolutely a potential risk for the world today.
Let's get some comments from the front row here.
Going forward, it's security that's actually coming back. You look at the most important economic, geoeconomic, and geostrategic relationship in the world, it's the relationship between the United States and China. And the lack of deterrence capacity, the lack of response of the United States on cybersecurity vis-a-vis what we're seeing, not just with Google, but with corporations that the United States have all over the world, you're just going to have to put massive resources into that. Also, the increasing scarcity of resources that we see, hard resources in the ground, and the competition that we will see between major powers over them implies that hard power is going to become more significant, not less.
The key challenge right now, as Kenneth said, is working out how to deal with these spiraling deficits. And that requires governments to take very tough decisions about how to allocate pain, how to divide up a shrinking pie. And countries like America have not had any practice at doing that in the last few decades. The last couple of years have been all about testing the global financial system and seeing weaknesses in global financial institutions. The next 2 are going to be about testing the political machinery. I suspect that the results will be equally disappointing.
Certainly, I agree that it's difficult to finance 2 wars, and we certainly have to think about that in a deep way. But the size of the deficit is so large that any realistic trimming of the defense budget will not get us to certainly anything approximating a balanced budget.
No one thing will, so you might as well give up. But I am talking about, if we get this right, well over $100 billion a year. I know we need to deal with cybersecurity, but I haven't voted for the airplane that's going to protect cybersecurity. We've got nuclear weapons. We are so over-weaponed. We have got weapons that are wonderful, but they have a major defect. They have no enemy. And that ought to be a requirement for a weapon, that it have an enemy, i.e. a mission. No one thing does it. But I believe that we could cut, if we were to downsize, you can't just downsize the military. You have to downsize our aspirations. We have to be less concerned that we're going to fix everything everywhere. By the way, it does more harm than good when we go in to try, in most cases anywhere. I am talking about saving well over $1 trillion over the next 10 years from the military budget without any risk whatsoever to American security.
Yes, sir.
I also think we don't take into account enough the resilience of our species. When you have doomsday warnings, people react. People will put in liquidity ratios. Basically, I think this is not the sword that we should be worrying about.
I'm sorry, but if you look at history, people don't always react. That's why we have debt crises. That's why we have problems again and again. And I think the idea that we're simply going to grow our way out, as we did after World War II in the United States, it happens sometimes, but more often you have to make tough choices, like Barney Frank has talked about. The public is not prepared for this. The government's guaranteed everything. Everything's fine. And they don't have this vision. And that's where our leaders have to lay out a political
They're not only not
vision.
prepared, they're prepared for the opposite. As to raising taxes, I voted to raise taxes. I think almost every American here pays much less in taxes than you ought to. And I'm going to go back and try and raise the taxes of most of the people who attended here. I think hedge funds should pay the capital gains rate. We shouldn't have dropped the 39% rate to 36 under Bush. When we reduced the rate, the marginal rate from 39 to 36%, I don't think any of the people making $1 million stopped going to work on Saturday. I don't think they started taking longer lunch hours. I don't think, and the statistics bear this out, that raising the rate from 36 to 39% under Bill Clinton had any negative effect because we had great job numbers after that. So yes, I am for raising taxes on appropriate people in the appropriate way, and I believe, I would just tell you, we had the 9 CEOs of the major financial institutions before us, and we asked them about their bonuses, and I said, what is it that you do because you get a bonus that you wouldn't otherwise do? They said nothing. So I said, let me be your cost consultant. Stop paying the bonuses because you're not getting nothing for it.
Ken Rogoff, are you done with your rebuttal?
I mean, here's the thing about raising taxes, 36 to 39%, fine, but it may be a lot more before this is over. The amount at which the federal tax take needs to go up ultimately to tighten our belt is a lot more than that.
Can I just add,
we're not against the government working, but nevertheless, if the Chinese don't continue to lend money to the United States, when you and your colleagues vote to pay the higher interest payments, where's the money going to come from?
Bottom line, we will take a short break. When we come right back, if politicians abandon free market capitalism as we have known it, what are the possible outcomes? Stay with us.
Undermanned and overwhelmed, regulators watched helplessly as the global financial system neared collapse.
The atmosphere was one of huge apprehension, a real fear about what was going to come down on us.
But will overregulation plant the seeds for the next global crisis?
You can't just regulate for this. The answer has to rest with the industry.
That debate and more when we come back to the World Economic Forum in Davos, Switzerland. This is Back to the Future, the next global crisis.
Welcome back to the World Economic Forum in Davos, Switzerland, where we are asking if there are unseen dangers on the road to recovery. President Obama has said that we can never again allow banks to stray too far from serving customers. But will tighter reins strangle the industry? I invite Lord Peter Levene, chairman of Lloyd's of London, to argue that overregulation will cause the next global crisis.
Maria, thank you. And of course, we all know about the crisis, and perhaps the answer, as you've heard, is to have new regulation. You know, I'm from the government. I'm here to help you. You guys in the industry don't know what to do, so we're going to fix it for you. Well, we heard that before. You remember something called Sarbanes-Oxley? Sarbanes-Oxley was a huge success, and not, I think, for New York and for the United States, but it was a huge success for London. In the City of London, we wanted to build a statue to Messrs. Sarbanes and Oxley for delivering so much business to us. But this time, we're going to get it right, because we're going to have internationally coordinated regulation. So what's going to happen then? New York, London, Paris, Frankfurt, we're all going to be in it together, so there won't be any escape. But we forget about where we are now. In Switzerland, in Singapore, and in Shanghai, you can't just regulate for this. The answer has to rest with the industry. And before you say, well, they're the bad guys because, tied up with regulation is the other R word, remuneration. They've been paid obscene amounts of money, and we've got to stop that. Now, did a lot of them get obscene amounts of money? Sure. Was that really the cause of the crisis? I'm not so sure. But politically, it's very sensitive and it has to be controlled. And the first good signs, if you're looking for green shoots, if you notice in the last few days, you've had Goldman Sachs, you've had the chairman of HSBC saying, hey boys, this is not on anymore. So they do listen. And I think that this is really what it's all about. The industry has to deal with it itself, because that's where we're going to get the recovery. And if they don't, they're big enough to understand that they've got to get this right. Just remember the rules we give our children in road safety. Stop, look, listen, add one word, and learn. Thank you.
Interesting analogy of that New York and London, the challengers.
Let's go back to the future as you suggested, Mario. I saw last year's debate, almost the same cast of characters here. And I remember that at that time the atmosphere was one of huge apprehension, a real fear about what was going to come down on us. President Obama was saying the same things, talking about greed and irresponsibility. I remember Duncan was here, he was worried about too much regulation, and you argued, Duncan, let's keep the same regulations, let's not over-regulate. But what's happened since then? Nothing really has happened. That drawbridge hasn't come down on us. And frankly, the noise is being made by President Obama. Similarly, right now, very fuzzy, not very comprehensible. I think he took the eye off the ball, probably onto healthcare, but that's a different story. The question is, what are the demons that he's threatening to unleash? What is it we're really scared about? He hasn't even said bring back Glass-Steagall, which frankly he ought to. At least son of Glass-Steagall should be back here. All he's suggesting is applying the lessons that we learned from the last great crisis. Glass-Steagall came out of that. So I don't see some real specter of overregulation coming in. But we need to make things happening. Lord Levene, you argued last year that you were voluntary. You talked about Lloyd's and how things had happened on their own. I don't think it will happen on their own. I think you're going to have to make banks, real banks, stay with lending. They're going to have to lend to real people, to build real things, and to have real food on their table and real homes. That separation will have to be done by government. Those who want to play Vegas, be high rollers, let them go with the speculators. Somebody's got to enforce that separation. So I really believe that somebody needs to fix that, and you need to fix the perverse incentives that operate right now. Right now, you do have people being rewarded for short-term incentives, and the fact is, as Stiglitz said, you've got to align those private incentives with social returns. Somebody else has got to do that. That's not over-regulation.
Congressman.
First, for Lord Levene's metaphor about telling the young people about the rules of safety, apparently Lord Levene would add, oh, and by the way, there will be no traffic lights and no traffic policemen, because what he says is keep the government out of it. Now, telling people to go do that with no traffic lights, no traffic cops, and know which side of the road you ride on would be a problem. He says, well, what about Singapore and the others? Yeah, that's a problem. I do believe that if we get much of the developed world together, as we are in the process of doing, and I do remember, yes, the Financial Services Authority was the siren luring people away under Sarbanes-Oxley, and the head of it said, of course, about a year ago, the era of light touch regulation is over. We have the head of JPMorgan Chase complaining to the Chancellor of the Exchequer about excessive compensation restrictions, and then telling us, don't be excessive. Mommy and Daddy can't get played against each other anymore. Now, there are the outliers. In the bill that the committee that I chair passed, we instruct the Federal Reserve and the Secretary of the Treasury to exclude from the American economic system, to the extent possible, any country which is deemed to have too lax of regulatory structure. And we've learned how to do that. Ask the people at Bank Melli, ask others. Through the sanctions regime, our Treasury has gotten pretty good at excluding people who play those kinds of games. Now, as to leaving it to people without rules, one of the arguments we get from the people in the industry is, I have to do it because the others are doing it. When we asked Citicorp why they were not putting structured investment vehicles on the balance sheet, since they were liabilities, Mr. Prince said to me, well, if I do it, I'll be at a competitive disadvantage vis-a-vis Goldman Sachs. If I cut my salaries, they'll go work for elsewhere. So we need rules. Stupid rules are not a good idea, but rules are a good idea.
With all due respect, who's policing government? Didn't we have rules in place? How come they broke down?
Because the people who were in charge of them didn't believe in them. Alan Greenspan, to his credit, acknowledged that, for instance, in 1994, when he was given the mandate to regulate subprime loans, he refused to do it because he did not believe in regulation. No question, if you get people in power who refuse to use the rules, they won't be used. But it wasn't that they tried to be used and were badly done. Ben Bernanke has taken some of the powers that Alan Greenspan refused to use and put them to good use.
Yes, sir.
I believe that this new regulation needs to strike a balance between our need to promote innovation and entrepreneurialism, but at the same time to really stop the abuses of the past. I think that the people in the financial services industry should not be frightened by more regulation because it also creates, paradoxically, business opportunities. So I think that the key point that you raised, and it's where I would agree with you, is that what is needed is a harmonized, we need to have a harmonized global regulation.
Jumin.
If we take 2007 as a peak, at that time, the whole banking sector accounted $69 trillion US. The whole bonds market accounted $73 trillion. And the stock market cap is $68 trillion. Plus, we have a derivative market face value is $664 trillion. If you add them together, it's a 16.65 times of a global GDP. The global GDP of that year is $55 trillion US. So questions whether we need a 16 times 16, 6.1660 times size of financial sector work for the real economy. I think the financial sector obviously goes too strong. The second issue is if you're looking for the income, everybody talk about that. From year 2003 to 7, the global banking sector have an average ROE roughly for 14–15%. But if you take them back, from year 2002 back to 20 years, the global banking sector have an average ROE 10%. 08 is over 2.68% because of crisis. But I would say for the whole financial sector, maybe the return on ROE should be around 10% because this is very much a service sector. You bear the responsibility to maintain the service to the public. You should not shooting for 19–20%, even more ROEs. And for example, currently, a particularly weak issues, if you're looking for the financial sector, it's still very fragile. The balance mismatching is still a big issue there. The financial sector still have a lot of short-term liability sides and long-term assets. That's the exact issue what happened in Dubai. That's exactly happened in many financial institutes. Obviously, the regulation need to impose on those issues, and particularly on the capital surcharge, on the dynamic liquidity on those issues. Obviously, there's no perfect regulation, as you mentioned, but there's no perfect market either. We need to find a way between, but after this crisis, a more regulation, I think, is deserved.
Mr. President.
When there was a crisis, financial institutions were literally crying for government intervention. Without that government intervention, today we will be in the middle of a great depression. As well as there is market failure, there is also non-market failure. So you have to be very clever about what kind of regulation. But just simply say that if we have more regulation, it is going to be the seed of the next crisis, I think it's a terrible mistake. I think the financial sector has to be more constructive, has to recognize what was wrong, and of course, legislators have to be less under the impulse of populism and popular pressure and really produce clever, intelligent, enlightened solutions for this mess.
I think we're making it too binary. We're arguing in some cases after a crisis like this, how could we do nothing? And then at the same time, we're arguing, yes, but our history tells us after a crisis, we tend to emotionally overregulate. And the facts don't support either one of those arguments, in my humble opinion. We had markets that have worked and did work through the crisis. They have a big dose of transparency. They have regulations underlying them. And those markets, including ours, performed extremely well. Instead of complicating it, if we agree we want to do something in the wake of the crisis, let's look at examples of markets that worked, as self-interested as that sounds, and let's see if we can apply regulatory constructs that we know worked. And by the way, don't buy the argument that it constrains volume or it constrains the ability for markets to grow, because the US equity markets and the global equity markets, volume has grown exponentially in the last few decades. So I don't buy the argument that says, oh, if we regulate them, we'll stifle liquidity. It's simply not true.
If you had a world where banks were sufficiently transparent that their shareholders could see, say, who was getting the big bonuses and why, then you might actually have shareholder pressure and market pressure to try and rein in the compensation structures. And similarly, if you had a world where the bank's clients could see what kind of margins the banks were charging for the products, then you'd have a world where banks may not be quite so profitable. So if Lord Levene wants a kind of world where banks actually look after themselves, essentially try and control their own activity, they have to be transparent enough to actually have genuine market pressure, imposing some kind of constraint as well.
If I may contend that a little bit, Maria, I think let's try to focus on what the crisis was all about. It was not a crisis of corporate governance. It was not a crisis about compensation. They may have been second or third or fourth order effects. It goes back to what Chairman Frank said, which is, I agree, we want more transparency from the banks or all public companies. It goes into showing what's on the balance sheet, right? That's what I think you want the investors to be able to see, because then they can better police the companies that they're investing in. If you can't see it, you can't risk manage it.
Okay, thank you. Lord Levene, you have 30 seconds to rebut these concerns.
First of all, from what Barney Frank said, I love traffic lights. I just don't like the ones which stay green for 5 seconds and red for 55 seconds. They're the ones we need to avoid. And the other thing, I think, which is very, very helpful in this debate is this. There's been virtually no discussion about compensation. You pick up the newspapers, that's what it's all about. It's all about compensation. We've had a sensible debate about regulation. Compensation is a side issue. And just one last point. They asked that we should have compensation where there was a long-term incentive. Now look at the compensation at AIG and at Lehman Brothers and the people who benefited from that. That will tell you that that is not necessarily the answer. But let's get good regulation, better regulation, but not more regulation. Thank you.
Thank you, Lord Levene. After the break, we will hear why it could be dangerous for everyone if governments remain major owners in financial markets.
United we stand. Global corporations and global investors can mean only one thing: a global economy.
Free trade is win-win if the metric is countries. But within countries where decisions get made, it is not win-win.
But with the popularity of protectionism on the rise, are politics getting in the way of policy?
It is the strongest breeding ground for potentially bad policies.
We'll have more from the World Economic Forum in Davos after the break. You're watching Back to the Future, the next global crisis.
Welcome back to our debate, where we are examining the challenges and choices to be made to prevent another global crisis. I invite Dr. Jacob Frenkel to put forward the proposition that there is a danger that governments will retreat to protectionism and be tempted to politicize monetary policy.
Ladies and gentlemen, when there is a deep recession, as we have, it is the strongest breeding ground for potentially bad policies. And indeed, governments all over the world have reacted very aggressively, and I would say properly so, to the crisis that we have been living through. There is a danger, however, that moving forwards, we will fall into the trap of excessive interventionism, excessive protectionism. Look what happens to our ammunition. Monetary policy cannot do now anything anymore. Interest rates are at zero. Where else will they go in order to stimulate the economy? Fiscal policy can do very little today. Budget deficits are already very large, and debt is increasing. And this may stifle growth in the future, because there is no question that long-term interest rates will go up as debt rises. So what can be done? The danger is, with the excessive zeal to protect us all from that crisis, government will be overly activist. And let me talk about protectionism. If there is one proposition that is universally agreed upon from the history, it is that free trade is a win-win proposition. That protectionism is negative for growth in the medium term. That free trade is not a speech, it's an action. And yet the reality is that all over the world, we see tendencies for protectionism. I feel this is a great danger, because protectionism is not just trade. Protectionism is a state of mind. It's a state of mind that thinks that globalization is bad, that emerging markets should be separated from us, that China is a threat rather than opportunity. This entire mindset has to be put aside towards long-term thinking, where openness is the key.
Thank you, Dr. Frenkel. The challenges.
I don't think anyone can argue that protectionism is not a danger. What I'll try and do is say that the imminence and the significance of that threat is not as large as one might want to be paranoid about. So let's travel back in time again, back to the future, as you said. Last year, candidate Obama was making serious noises in his campaign, which sounded very protectionist. In fact, the Indian IT industry was quaking in its boots, thinking that he was going to put a tax on companies that outsourced. And what happened? Nothing happened. And the reason I think nothing has happened as yet is because there's a recognition of three things. One is that US companies will become uncompetitive if they're taxed for outsourcing. They are just not going to be able to compete with companies and new MNCs around the world that treat the world as their supply chain. Look at Apple, for example. Apple has shown terrific results, a new product coming out. But the US has, I argue, successfully moved to a model of innovation, but the implementation to make Apple show those profits depends on a global supply chain. You're going to tax Apple and make it uncompetitive? I don't think so. Second one is that if you get protectionists, India and China and others will put down the barriers as well. Which multinationals, which US companies would want to be cut off from those growing markets? And finally, you can't thumb your nose at the referee of the world, the WTO and other people when there's a force majeure situation. If the economy had continued to slide, if unemployment was continuing to go downwards, but there is a kind of recovery, economies are recovering, this is not the time anyone will condone that kind of protectionism. What I would argue, though, is that America will use this opportunity to put pressure on India and on China to lower its barriers. And these might be bilateral in nature. Classic anecdote I can give you is that the last regime put enormous pressure on India to lower the barriers for Harley-Davidson motorcycles. And in return, we were allowed to export mangoes to the United States. Now, I see Hells Angels clubs starting up in Mumbai and Delhi. Of course, I think it's a little harder to imagine an American Hells Angels chewing on a mango while he's on the motorcycle. So I think we got the short end of the deal. But I think that's what will happen. I don't think it's a big threat.
Well, it is a big threat. And it's the fault of the financial establishment that it is. Jacob Frenkel is right that from the macroeconomic standpoint, free trade is win-win if the metric is countries. But within countries where decisions get made, it is not win-win. If we are not able to do a better job, certainly in the US, and I suspect in much of Western Europe, to better distribute the fruits of free trade, then you will see protectionism. And yes, you can argue that in the long run, everyone will be better off, but everybody here knows it, and they can say it with me, what John Maynard Keynes said, and every worker understands this instinctively, in the long run, we shall all be dead. They're not waiting around for their kids who are having to drop out of school. So protectionism is always, it's been a danger. It will get worse. There are ways to alleviate it. There are ways to do it, but the problem is that the free trade purists have also been free market purists at home and have created a situation in which there is a great deal of anger. And free trade, somewhat unfairly, is identified with a increasing maldistribution, and there has to be a joint effort to change that.
Thank you, Congressman. Front row comments. Yes, sir.
I think domestic politics will play very much in favor of protectionist pressures. So I think two things have to be done. Number one, what Representative Frank is mentioning, it's about time that people or governments, leaders, do something about the distribution of gains from trade. Jacob is right. Ideally, in a perfect world, it's a win-win situation. But we also know from theory that there are winners and losers within societies, and there must be active mechanisms to compensate not all, but some of the losers. And the other biggest step, of course, is to conclude whatever watered-down Doha deal is available to complete it as soon as possible. And the bad news there is that we don't see the will, we don't see the political leadership, we don't see any practical step to conclude Doha. And that is going to be a massive mistake because the water that you have between bound legal tariffs and applied tariffs is huge. So you could have an upsurge of protectionism that will be actually legal, and nothing will be done about it.
Thank you, Mr. President. Ian Bremmer.
In Bangalore, they've been winners. In Detroit, they've been losers. Ask local populations what they think about free trade. They'll tell you very different things today than they used to. I agree with Barney on this one. This is structural. World Economic Forum has been around for 40 years now, and the globe has had a pretty strong economic run. And that's in part because multinational corporations have increasingly taken advantage of global access to capital, to labor markets, and to consumer markets. And this is structural. Over the course of the last 15 months, what we've seen is that increasingly you don't have a single system that runs the global economy, but instead you have two. You have one in the West where we have multinational corporations that still operate in a dominant position with somewhat more, somewhat less regulation. And then you have state capitalist systems that are some of the fastest growing in the world economy, where the state is the principal actor and arbiter. And frankly, in an environment where we're now seeing 10% growth in China, 10% unemployment in the United States, those things do not add to 20. Protectionism is by far, in my view, the world's largest risk this year.
Thank you.
Protectionism is absolutely right below the surface. We should remember well in the middle part of 2008, at the front end of this calamity, when many countries around the world put up their borders and food stopped flowing and grain stopped flowing. And I tell you that we're not very far away from the next such crisis, just the minute that countries perceive that they don't have enough of the very basic needs for their population. And another crisis that's looming out there before all too very long is a water shortage. And we haven't talked about some of those longer-term threats to the human population around the world. And the natural tendency for governments and for countries is to take care of their basic needs first, and trade is the first thing that goes out the door. There's nothing about Copenhagen, there's nothing about Doha that should give us encouragement that this isn't the natural tendency.
Yes, sir.
When there are regulatory differences across different markets, it actually really puts friction in capital flow, and that sort of creates economic hurdles to economic growth also. And we are starting to see, even though there's a lot of intent to have global coordination across regulations, but there is no, the practical aspects of it is not happening. And you're starting to see a lot of fragmentation in regulation around the world, and that will create a lot of friction in capital flow and impact the economic growth. Now, there are cultural, there are behavioral and structural differences by market that justify some differences by regulation. But every country, in the interest of ring fencing themselves, are starting to put some regulatory differences, and that will create a big risk for us.
Thank you very much.
Today, people so much focus on manufacturing, but there's high technology products, there are agri products, there are service areas, there's so many areas. I think it's a typical issues we need to working together to enhance the global leadership to promote Doha negotiation move further. I think it's absolutely important. But I'm really interested in the gentleman mentioned about capital flow. I would like to go a little further about that. I think if you're looking for, particularly this year, I think it's a real risk for this year global economy is a capital flow. Because what we thought is because very weak dollar, the zero interest rates make the carry trading on dollar. It's a massive issue today. The estimation is around $1 to $1.5 trillion. This is much, much bigger than the size of Japanese yen carry trading, say, 10 years ago. Now, what we thought in the past 12 months, when the crisis hit the Western societies, the capital flow pulled out from emerging economies. And we saw those Russians, Indians, South Korea, Indonesia currency depreciate 30%. Now we thought what happened 4 months ago when the capital flow ran back into the emerging market. Those currencies appreciate another 30%. It's created huge volatilities. And everybody understands because it's dollar carry trading, all this money is run into the emerging market. And everybody understands in some day, if the US monetary policy changes, this money will come back, will go back to the US state market, will cause a big problem. This is exactly the lesson we learned from 1998, this Asian financial crisis, because the Japanese changed their policy, the yen have to go back to Tokyo market, that caused the liquidity issues. Then obviously local economy have their structure issues. Two things get together. We had the Asian financial crisis. And today, everybody are concerned whether the direction of the capital flow will move. I think there is absolutely a real risk for the year 2010.
What about the adjustment in the Chinese yuan?
It's very important to have a stable year, particularly with this very volatile market. I mean, it's important if you see 12 months ago, when all this Asia currency depreciated, yen stable. And 4 months ago, when all the currency appreciated, yen stable. It's good for China, it's also good for the world.
Couldn't it be stable a little higher? Stable is one thing, level is another. Could be stable a little higher.
There's also...
Thank you, gentlemen.
My plea is to make free trade a win-win proposition. The fact that there are losers is not a justification for protectionism. It is a justification for the adoption of trade adjustment programs that are helping those that are hurt and programs that are fully budgeted. But let's not interfere with the free flow of goods. There is a broader issue. We are always trying to bridge the conflict between the short-term imperative and the long-term necessity. But we speak only about the short term. So when we speak about budget deficit, we say it's essential now, but what about the long term? Yes, we do need to have a budget deficit, but I have a plea. Again, each speech that speaks about a detour from the long-term trend for the benefit of the short term should include in it a statement about the end point. How are we going to end this journey? The stimulus budget would have been much more stimulating than what it has been if at the same time there was clarity about how the end game ends, who is going to be taxed, what spending is going to be cut, and when, not necessarily calendarically, but at least on the phase of the cycle. So let's not forget the long term, which is again an excuse for short-term protectionism.
Jacob Frenkel, thank you very much. Don't go away. When we come right back, we'll find out what our audience thinks. We will be voting on which of our three speakers has put forward the most convincing case.
A voice for the people. The debates have been made. Now the audience has its say. Where does the next crisis lie? You'll find out when we come back. This is Back to the Future, the next global crisis, a CNBC special debate from Davos, Switzerland.
Welcome back to the final part of our debate, where we have been bringing the focus back to the future. What are the challenges ahead going to look like? You've heard the arguments. Let's see which of our three proponents has made the most convincing case for the most dangerous threat on the road to recovery. Professor Ken Rogoff has argued that the banking crisis has morphed into a long-term government debt crisis. If you agree, please, all of our audience members, press number 1 on your voting console. If you are more persuaded by Lord Peter Levene's case that overregulation will cause the next global crisis, press number 2. Dr. Jacob Frenkel sees the danger that governments will retreat to protectionism and politicize monetary policy. If you agree that is the bigger threat to global stability, then press number 3 on your console. Let's take a look at the results. Overwhelming, 50.7% said sovereign debt is the biggest threat, followed by protectionism at 37.3%. 12% of you believe overregulation is the threat. Thank you very much for weighing in. CNBC, by the way, has been running an online poll in association with LinkedIn. We asked our viewers which of 5 potential threats to the global economic system should have our most urgent attention. And there are the results. 36% of viewers and users said national debt levels, environment or climate risks came in for 26% of you. International banking regulation on 21%, geopolitical developments at 9%, and China's economic outlook came in at number 5 with 8%. Thank you all for your participation today. We so appreciate your time today. You've been watching CNBC, the debate from the World Economic Forum in Davos, Switzerland, where we have brought the focus back to the future to consider potential pitfalls on the road to recovery. Thank you. Good night. Welcome back to the final part of our debate, where we have been bringing the focus back to the future. What are the challenges ahead going to look like? You've heard the arguments. Let's see which of our 3 proponents has made the most convincing case for the most dangerous threat on the road to recovery. Professor Ken Rogoff has argued that the banking crisis has morphed into a long-term government debt crisis. If you agree, please, all of our audience members, press number 1 on your voting console. If you are more persuaded by Lord Peter Levene's case that overregulation will cause the next global crisis, press number 2. Dr. Jacob Frenkel sees the danger that governments will retreat to protectionism and politicize monetary policy. If you agree that is the bigger threat to global stability, then press number 3 on your console. Let's take a look at the results. Overwhelming, 50.7% said sovereign debt is the biggest threat, followed by protectionism at 37.3%. 12% of you believe overregulation is the threat. Thank you very much for weighing in. CNBC, by the way, has been running an online poll in association with LinkedIn. We asked our viewers which of 5 potential threats to the global economic system should have our most urgent attention. And there are the results. 36% of viewers and users said national debt levels, environment or climate risks came in for 26% of you. International banking regulation on 21%, geopolitical developments at 9%, and China's economic outlook came in at number 5 with 8%. Thank you all for your participation today. We so appreciate your time today. You've been watching CNBC, the debate from the World Economic Forum in Davos, Switzerland, where we have brought the focus back to the future to consider potential pitfalls on the road to recovery. Thank you. Good night.